Get ready for the action, because we are diving straight into the massive growth in Latin America. We are talking about the incredible industry data centers poised to reignite wind growth by 2027. This isn't just a small trend. We are looking at over 11,000 projects across Latin America, with over 24,000 global companies actively doing business in this region, and an astonishing 83,000 key contacts ready to connect you with this booming market. Racks are pushing physical limits, and what crucial changes, like liquid cooling, are needed to make these older sites viable for the AI revolution. Finally, we look at the massive investment fueling this shift, focusing on FuelCell Energy. We analyze why this company is surging on the heels of a major 12.5 megawatt fuel cell launch aimed squarely at power-hungry AI data centers, and whether its current valuation reflects the immense future growth potential in the AI infrastructure market. Stay with us to see what this means for your portfolio and what the key risks are. Brazil's wind energy sector is poised for a significant resurgence, driven by robust industry and data center investment, with projections pointing toward renewed growth by 2027. This optimistic outlook is supported by a substantial ecosystem in Latin America. The region is characterized by a dynamic business environment, boasting over 11,000 wind projects underway, and a significant concentration of global activity, with more than 24,000 companies actively engaged in the market. Furthermore, the network is strengthened by over 83,000 key contacts related to both companies and potential projects. To facilitate this growth and connectivity, a wealth of information is available across multiple languages, including analysis, reports, news, and interviews provided in English, Spanish, and Portuguese, underscoring the region's growing importance in the global energy landscape. Experts are addressing the unprecedented power demands of artificial intelligence data centers, asserting that a proven blueprint for solving this challenge already exists, rooted in 3 core principles that require renewed commitment. Speaking at recent power conferences, industry veterans emphasize that while AI computing demands are massive, technological innovation can mitigate the strain, mirroring past shifts like the cloud era. The historical context drawn is crucial. The surge in power demand during the 2010s cloud boom was countered by industry-wide improvements. Significant drops in power usage effectiveness, PUE, were achieved through economizer cooling, advanced power distribution, and smarter infrastructure management. Furthermore, hyperscalers adopted large-scale renewable power purchase agreements, injecting billions into the grid, while early machine learning tools dynamically optimized energy consumption, exemplified by Google's DeepMind reducing cooling energy by approximately 40%. This history suggests that technology and collaboration can solve the problem, not just exacerbate it. The timing is critical as AI power demands coincide with a national grid nearing the end of its design life, with approximately 70% of the infrastructure built between the 1950s and 1970s being inadequate for modern digital scale. The data center boom is now acting as a catalyst, exposing long-standing grid deficiencies that require fundamental modernization for the next 50 to 100 years. To meet future demands, the strategy involves leveraging AI for smarter power use and grid stabilization. However, the solution extends beyond the grid. Intelligent systems within data centers are already redefining efficiency and resilience. The author stresses that technology alone is insufficient. Progress hinges on people and policy enabling collaboration between utilities, data center companies, regulators, operators, and government agencies. A key call to action is the shift from parallel work to true partnership. Utilities, data center operators, and government must engage in transparent planning, aligned incentives, and shared data to ensure reliable, resilient power that supports economic growth and affordability. The conclusion is optimistic. A new playbook is unnecessary. By fostering genuine collaboration, shared infrastructure investment, and purposeful technology application, the industry can successfully meet the power needs of AI and build the foundation for the next century of innovation. FuelCell Energy, ticker FCEL, has regained significant attention from traders following the launch of its 12.5 megawatt fuel cell platform, specifically designed for power-intensive AI data centers. This announcement triggered a stock price surge exceeding 20%. The recent performance is part of a substantial upward trend, evidenced by a 7-day share price return of 55.91% and a 30-day return of 194.62%, contributing to a year-to-date gain of 161.44%. However, this short-term momentum contrasts sharply with a weaker long-term trajectory, marked by a 66.42% decline over 3 years and a 92.01% decline over 5 years. Analysts currently place a fair value target for FuelCell Energy at $8.24 per share, which is significantly below the last closing price of $21.36. This valuation is predicated on detailed forecasts concerning growth, margins, and discount rates. A key driver for this valuation is the company's pipeline, which includes over 1.5 gigawatts of proposals, with more than 80% directed towards data centers. This focus aligns FCEL with a segment that prioritizes reliability and long-term power solutions, potentially supporting longer contract durations and improved cash flow visibility if projects are secured. Despite the optimistic pipeline narrative, concerns persist regarding the company's recent first-quarter miss, a history of losses, and uncertainty surrounding clean energy, tax credits, and incentives. While the company operates in the high-temperature fuel cell sector, boasting an adequate balance sheet and low risk, the market sentiment remains split between excitement and caution. Investors are urged to conduct thorough due diligence, examining revenue, margin, and future earnings multiples to determine if the current market price reflects years of anticipated growth, or if the stock is mispriced. The analysis suggests that while the narrative supports a lower valuation, risks related to execution and regulatory factors could temper future performance. The rapid expansion of artificial intelligence infrastructure is placing immense pressure on existing data center facilities, forcing operators into a race to retrofit aging infrastructure to handle soaring power, cooling, and density demands. While new construction is addressing scalability, retrofitting legacy sites is emerging as a critical, immediate strategy to bring incremental AI capacity online, especially as utility interconnection timelines delay new builds. Existing data centers, designed for lower density computing, typically supporting 4 to 10 kW per rack, are struggling to meet the requirements of modern AI systems, which demand significantly higher power loads. This gap is widening, straining power distribution systems originally designed for lower densities. Experts note that high-density AI racks can weigh up to 1.5 metric tons, challenging floor loading limits in multi-story buildings. Power distribution is cited as a primary bottleneck, particularly when operators attempt to push densities above 40 to 50 kW per rack at scale. The availability of necessary infrastructure, such as large capacity breakers and busways, is becoming a limiting factor. Cooling presents a parallel hurdle. Traditional air-cooled environments are hitting thermal limits, prompting a shift toward liquid cooling, although integrating liquid cooling into existing mechanical systems requires substantial facility overhauls. Industry analysis suggests that the focus is shifting from a binary choice between hyperscale and enterprise to a segmentation based on workload type, distinguishing between AI factories and general-purpose data centers. Many operators are pursuing partial upgrades, carving out sections for high-density deployments, or pairing legacy sites with new infrastructure, rather than full conversions. Despite these efforts, the pace of retrofitting alone is unlikely to keep pace with the surging demand. Projections indicate that hyperscale operators will command a majority of global data center capacity by 2031, with existing capacity designed for CPU-based workloads doubling by 2026 as new capacity is built specifically for AI. Ultimately, the immediate future for legacy facilities involves overcoming inherent physical limitations to maximize utilization, with the challenge shifting from the feasibility of retrofitting to the effectiveness of overcoming those limitations to meet relentless AI demands.